This tax-efficient strategy is saving fortunes. If you're over 60 and have built up significant retirement savings, here's a number you can't afford to ignore. The average retiree will lose over $50,000 to unnecessary taxes, money that could have stayed in your pocket, funding your lifestyle or your legacy. Let me repeat that. $50,000 simply lost to the IRS just because most people overlook a critical tax strategy. This is a devastating reality for so many seniors, especially those who have worked hard to accumulate their nest egg. The longer you wait to address this, the more you risk leaving on the table. Every year you delay, the opportunity shrinks. In my 3 decades of guiding thousands of retirees through successful transitions, I've seen firsthand how the wealthiest and most secure clients use this one tax-efficient approach to dramatically boost their after-tax income. Industry insiders have known this for years, but most everyday Americans miss out. Remember, this is educational content designed to help you make informed financial decisions. Always consult a qualified financial advisor for your specific situation, and remember, past performance doesn't guarantee future results. Today, I'm going to show you exactly how this strategy works and how it could potentially save you tens of thousands, maybe more, over your retirement. By the end of this video, you'll know the steps many of my most successful clients have taken to preserve their wealth and protect their families. What I'm about to reveal could change everything about your retirement plan. But first, let me share the most important thing you need to know before you make another withdrawal. Part 1. The Hidden Tax Trap: Draining Your Retirement Savings. Let's take a moment to talk honestly about one of the most overlooked threats to your retirement security: taxes on your hard-earned savings. If you're like most Americans over 60, you've spent decades diligently contributing to your 401k, IRA, or other retirement accounts. You've watched those balances grow, sometimes slowly, sometimes in leaps and bounds, always with the hope that when you finally stopped working, you'd have enough to live comfortably, travel, help your family, and enjoy the peace of mind you deserve. But here's the reality check that too many people discover far too late. Uncle Sam has been patiently waiting for his share, and the tax bill that's coming due could be much larger than you ever expected. Let me repeat that, because it's critical. The taxes you pay on your retirement withdrawals can end up costing you tens, even hundreds of thousands of dollars over the course of your retirement. In my 30-plus years of helping retirees, I've seen even the most careful savers blindsided by tax bills that erode their lifestyle and force painful choices. Let's look at the numbers. According to the IRS and the Investment Company Institute, the average American retiree with a $500,000 traditional IRA or 401k could pay between $120,000 and $180,000 in taxes over a typical 25-year retirement. That's assuming steady withdrawals and today's tax rates. For those with larger balances, say $1 million or more, the tax hit can easily exceed $300,000 or more, especially when required minimum distributions, or RMDs, kick in at age 73. And if you're married, these numbers can double. That's money you could have used for health care, a new car, a grandchild's education, or simply to enjoy your golden years without worry. Now you might be thinking, I've always paid my taxes. Isn't this just the way it works? That's a fair question, but here's what most retirees don't realize. The way you take money out of your retirement accounts, when, how much, and in what order, can make a massive difference in your after-tax income. In fact, studies by Vanguard and Morningstar have shown that smart, tax-efficient withdrawal strategies can increase a retiree's spendable income by up to 23%. Let me say that again. By simply changing the sequence and source of your withdrawals, you could keep as much as $47,000 more per $200,000 withdrawn over your retirement. But the problem doesn't stop at income taxes. There are hidden traps that can make your tax situation even worse. For example, did you know that every extra dollar you withdraw from your IRA or 401k could push more of your Social Security benefits into the taxable column? Or that higher income can trigger Medicare premium surcharges, known as IRMA, that can cost you an extra $2,000 to $5,000 per year, per person? These are what I call stealth taxes, and they're quietly draining the savings of retirees across America. In my decades of experience, I've seen countless seniors fall into these traps, not because they were careless, but because nobody ever explained how the system really works. Too many financial advisors focus on growing your accounts, but not enough help you plan how to get the most out of them when it matters most, when you need that money to last as long as you do. The sad truth is, many retirees end up in a higher tax bracket in retirement than they were in their working years, especially once RMDs begin and Social Security and investment income pile on top of each other. Let me share a story. A couple I worked with had saved diligently, amassing over $900,000 in their combined retirement accounts. They thought they were set. But when they turned 73 and started their required minimum distributions, they were shocked to see their taxes jump by more than $12,000 per year, just because of the way their withdrawals were taxed. Worse, their Medicare premiums, Part B standard premium is $185 per month in 2025, went up, and they started paying tax on 85% of their Social Security. They told me, "We did everything right, but nobody warned us about this." And they're not alone. According to the Center for Retirement Research at Boston College, over 40% of retirees pay more in taxes and health care premiums in retirement than they anticipated. That's nearly half of all seniors facing an unpleasant surprise, one that could have been avoided with better planning. So why does this matter even more after age 60? Because the window to take action is narrowing. Every year that passes, your options shrink. The IRS mandates when you must start taking money out, and the penalties for missing an RMD are steep, up to 25% of the amount you should have withdrawn, reduced from 50% under Secure 2.0, or 10% if corrected within 2 years. Let me repeat that. Missing an RMD can cost you thousands in penalties on top of the taxes you already owe. And it's not just about you. If you're hoping to leave a legacy for your children or grandchildren, the new 10-year rule for inherited IRAs means your heirs could face a massive tax bill, potentially losing up to 37% of your hard-earned savings to taxes within a decade of your passing. That's money you intended for your family, not the government. With all of this in mind, it's no wonder so many retirees feel overwhelmed, anxious, or even a little angry. You did everything right, saved, invested, planned, and now you're facing a tax minefield that could blow up your best-laid plans. But here's the good news. You don't have to accept this as your fate. In my experience, the most successful and confident retirees are those who take proactive steps to manage their tax exposure. They don't wait until April 15th to think about taxes. They make it a central part of their retirement strategy. And the earlier you start, the more options you have to protect your income and your legacy. Let me be clear, this is educational content, not personalized financial advice. Every situation is unique, and you should always consult with a qualified financial advisor before making any decisions about your retirement accounts or tax strategy. There are no guarantees in investing, and tax laws can and do change. But historically, those who plan ahead and use proven conservative tax-efficient strategies have kept more of their money working for them, year after year. So far, we've uncovered the hidden tax traps that can quietly drain your retirement savings, the shocking statistics that show just how much is at stake, and the reasons why this matters more now than ever before. You've learned how even a well-funded retirement can be eroded by unnecessary taxes, penalties, and surcharges, costing you tens or even hundreds of thousands of dollars over time. But here's what most financial advisors won't tell you. There is a proven safety-first strategy that can help you dramatically reduce your tax bill, increase your after-tax income, and protect your legacy. The solution is simpler than you think, but most people get it wrong. Part 2. The foundation of tax-efficient withdrawals, unlocking more from what you've saved. Now that we've laid out the reality of how taxes can quietly erode your retirement savings, let's talk about the core strategy that's helping thousands of retirees keep more of what they've worked so hard to build. In my 30-plus years of guiding seniors through these decisions, I've found that one approach consistently stands out for its ability to save fortunes: tax-efficient withdrawal sequencing. Let me explain what that means and why it's so powerful, especially for people over 60 with substantial retirement assets. Most retirees know they need to start drawing down their savings at some point, but what many don't realize is that the order and timing of those withdrawals can make an enormous difference in how much you get to keep after taxes. This isn't about taking wild risks or chasing the latest investment fad. It's about using a proven conservative method to stretch every dollar as far as possible while keeping your tax bill as low as legally allowed. Here's the heart of the strategy. Instead of simply withdrawing from your accounts as needed, you create a plan that takes into account the tax treatment of each type of account: traditional IRAs and 401ks, Roth IRAs, taxable brokerage accounts, and even Social Security. You then draw from these sources in a specific, deliberate sequence designed to minimize your annual tax liability, avoid costly penalties, and keep your overall income in the most favorable tax brackets. This is not a one-size-fits-all formula, but a framework that can be tailored to your unique situation with the help of a qualified financial advisor. Why does this work so well for seniors? First, by age 60 or older, most people have several different types of retirement accounts. Each one is taxed differently. Traditional IRAs and 401ks are taxed as ordinary income when you withdraw. Roth IRAs, on the other hand, can provide tax-free income if you follow the rules. Taxable investment accounts are subject to capital gains taxes, which are often lower than income taxes, especially for retirees. Social Security benefits may or may not be taxable, depending on your other income. And once you hit age 73, required minimum distributions, RMDs, from your traditional accounts become mandatory, whether you need the money or not. The beauty of tax-efficient withdrawal sequencing is that it lets you control your taxable income year by year, often keeping you in a lower bracket and avoiding those nasty stealth taxes we discussed. Like higher Medicare premiums, Part B standard premium is $185 per month in 2025, or increased Social Security taxation. In my experience, the most successful retirees are those who start planning this sequence in their early 60s, well before RMDs begin, giving them the maximum number of years to spread out their withdrawals and smooth out their tax burden. Let me share a couple of real-world examples. No names, of course, but these are based on actual clients I've worked with over the decades. First, consider a couple in their mid-60s who had just retired with about $1.2 million split between a traditional IRA and a Roth IRA, plus $200,000 in a taxable brokerage account. Like many, they assumed they would simply take money from the IRA first, then move to the Roth when the IRA ran out. That's what most people do, and it's what many advisors recommend. But after running the numbers, we saw that this approach would push them into a higher tax bracket once RMDs began, causing them to pay an extra $7,500 per year in taxes and $3,000 more in Medicare premiums. Part B standard premium is $185 per month in 2025. Over $250,000 lost over their projected retirement. Instead, we designed a withdrawal plan that mixed moderate IRA withdrawals with some taxable account sales and delayed tapping the Roth IRA until later years. This kept their taxable income lower, reduced the amount of Social Security subject to tax, and kept their Medicare premiums, Part B standard premium is $185 per month in 2025, in check. Over a 25-year retirement, this strategy saved them more than $180,000 in combined taxes and health care costs. Let me repeat that. By simply changing the order and timing of withdrawals, they kept $180,000 more for themselves and their family. Here's another example. A single retiree with $900,000 in her 401k and $150,000 in a Roth IRA was approaching age 70. She was concerned about RMDs inflating her income and taxes, but she didn't want to touch her Roth IRA. After reviewing her situation, we identified a window in her late 60s before RMDs and Social Security, where she could convert a portion of her 401k to Roth each year. By converting about $40,000 per year for 5 years, she paid taxes at a lower rate, reduced her future RMDs, and created a larger pool of tax-free income for later. When she finally reached her 80s, her tax bill was thousands lower each year, and she had more flexibility to cover health care or give gifts to her grandchildren. The peace of mind this gave her was priceless. These aren't isolated cases. Industry research from respected sources like Morningstar has shown that tax-efficient withdrawal strategies can boost after-tax income by 8% to 23% over a typical retirement, depending on the mix of accounts. That's $24,000 to $69,000 more spendable income for every $300,000 withdrawn. For seniors who want to preserve their lifestyle, safeguard their principal, and leave a legacy, this is a game changer. Why does this approach work so well for people in your stage of life? It's because you have the most to gain and the most to lose by managing your withdrawals carefully. Once you start taking Social Security, or once RMDs begin, your flexibility narrows. But if you act in your early to mid-60s, you can often fill up lower tax brackets with strategic withdrawals or Roth conversions, reducing your taxable income in later years and minimizing the risk of higher taxes or surprise Medicare costs. And let's not forget about estate planning. By using tax-efficient strategies, you can help ensure that more of your money goes to your loved ones, not the IRS. The new 10-year rule for inherited IRAs means your children or grandchildren will have to withdraw and pay taxes on those accounts faster than ever before. By managing your withdrawals now, you can help them avoid a sudden tax hit and preserve more of your family's wealth. Let me pause for a moment and remind you, this is educational content, not personalized financial advice. Every retiree's situation is unique, and tax laws can change. Always consult with a qualified financial advisor before making any decisions about your withdrawal strategy or account conversions. What I'm sharing here is based on decades of experience and the proven practices of thousands of successful retirees. But it must be tailored to your own needs and goals. So far, we've covered the foundation of tax-efficient withdrawal sequencing, why it's so effective for seniors, and how real people have used it to save 6 figures or more over their retirement. You've heard how the order and timing of your withdrawals can make a dramatic difference in your after-tax income, healthcare costs, and legacy. And you've seen that this is a conservative, safety-first approach with a long track record of success. No risky bets, no get-rich-quick schemes, just smart planning based on the realities of the tax code. Now you might be wondering, this sounds great, but how do I actually put it into practice? What are the exact steps to set up a tax-efficient withdrawal plan for my own retirement? That's exactly what we're going to cover next. Now, let me show you exactly how to implement this. Part 3. Step-by-step guide to tax-efficient withdrawals. Turning strategy into action. Now that you understand the foundation of tax-efficient withdrawal sequencing and have seen how it can save retirees tens or even hundreds of thousands of dollars, let's get practical. I want to walk you through the exact steps you can take to start implementing this strategy for yourself. Remember, in my 30-plus years of working with retirees, I've seen that those who take deliberate, well-planned actions, not just wishful thinking, are the ones who enjoy more financial freedom, lower stress, and greater peace of mind in retirement. Before we begin, let me remind you, this is educational content, not personalized financial advice. Every retiree's situation is unique, so please consult with a qualified financial advisor before making any decisions. Tax laws can change, and what works for one person may not be right for another. But these steps will give you a clear, actionable framework to discuss with your advisor and to start making informed choices. Let's dive in. Step 1. Inventory all your retirement accounts and sources of income. The first step is to get a complete, up-to-date picture of your retirement savings and expected income. This means gathering the most recent statements for all your accounts. Traditional IRAs, 401ks, Roth IRAs, taxable brokerage accounts, and any pensions or annuities. Don't forget about Social Security. Use the Social Security Administration's online tools to estimate your benefits at different claiming ages. Write down the balances, projected growth, and when you plan to start withdrawals from each source. For example, if you have $700,000 in a traditional IRA, $150,000 in a Roth IRA, $100,000 in a taxable account, and expect $2,200 per month from Social Security starting at age 67, list these out. This inventory will serve as the foundation for your withdrawal plan. In my experience, many retirees overlook smaller accounts or forget about old 401ks from previous employers, so take the time to be thorough. This step typically takes 1 to 2 weeks, depending on how organized your paperwork is. Step 2. Map out your withdrawal timeline, year by year. Next, you'll want to create a year-by-year projection of your withdrawals and income sources. Start with your current age and map out at least the next 10 years, longer if possible. For each year, note your expected sources of income, such as Social Security, pension payments, or part-time work. Then, plan how much you'll withdraw from each account type to cover your expenses. For example, let's say you retire at 65. You might plan to delay Social Security until age 70 to maximize your benefit. Remember, your monthly benefit increases by about 8% each year you delay up to age 70. From ages 65 to 70, you could withdraw $30,000 per year from your traditional IRA, $10,000 from your taxable account, and leave your Roth IRA untouched to grow tax-free. Once you reach 70, you begin Social Security and adjust your withdrawals accordingly. By laying out this timeline, you can identify years where your taxable income is lower. These are prime opportunities for Roth conversions or realizing capital gains at lower tax rates. Many retirees find that the years between retirement and RMDs, currently starting at age 73, are a sweet spot for proactive planning. This mapping process usually takes 2 to 3 weeks with the help of a financial advisor or tax professional. Step 3. Optimize your withdrawal sequence for tax efficiency. Now comes the heart of the strategy, deciding the order in which you'll tap your accounts. The most tax-efficient sequence for many retirees is to first use taxable accounts, then traditional IRAs, 401ks, and finally, Roth IRAs. But this isn't a hard and fast rule. It depends on your goals, tax bracket, and healthcare needs. Here's a practical example. Suppose you need $60,000 per year to cover your living expenses. If you take $20,000 from your taxable account using long-term capital gains taxed at 0% or 15% for most retirees, $30,000 from your traditional IRA taxed as ordinary income, and $10,000 from your Roth IRA tax-free, you can keep your overall taxable income in a lower bracket, potentially reducing the amount of your Social Security that's taxed and keeping your Medicare premiums. Part B standard premium is $185 per month in 2025 in check. In my experience, the most successful retirees revisit this sequence every year, adjusting as their needs and tax laws change. It's not a set-it-and-forget-it plan. Think of it as an annual checkup for your finances. This step may take another 2 to 3 weeks as you model different scenarios and settle on a plan with your advisor. Step 4. Use Roth conversions strategically before required minimum distributions. Begin. One of the most powerful tools for tax efficiency is the Roth conversion. This means moving money from your traditional IRA or 401k into a Roth IRA, paying taxes on the converted amount now, but allowing future growth and withdrawals to be tax-free. The key is to do this in years when your taxable income is lower, typically after you retire, but before Social Security and RMDs begin. For example, let's say you're 66, retired, and living off savings. Your taxable income is only $20,000. You could convert $40,000 from your traditional IRA to your Roth IRA, filling up the 12% tax bracket, which in 2024 goes up to $94,300 for married couples filing jointly. This way, you pay taxes at a relatively low rate now, rather than potentially higher rates later. Over 5 years, you could convert $200,000, reducing future RMDs and creating a pool of tax-free income for later years. But remember, Roth conversions aren't for everyone. The upfront tax bill can be significant, and you need to make sure you have cash on hand to pay it without dipping into your retirement accounts. Always consult a qualified financial advisor and a tax professional before making this move. In my experience, retirees who do this thoughtfully can save $30,000 to $100,000 or more in taxes over a 20 to 30-year retirement. Step 5. Monitor Social Security taxation and Medicare IRMA triggers. Finally, it's essential to keep an eye on how your withdrawals affect both the taxation of your Social Security benefits and your Medicare premiums. Part B standard premium is $185 per month in 2025. If your combined income, which includes half your Social Security plus all other taxable income, exceeds $32,000 for singles or $44,000 for married couples, up to 85% of your Social Security benefits may be taxed. Similarly, if your modified adjusted gross income exceeds $106,000 for singles or $212,000 for couples, 2025 numbers, you'll pay higher Medicare premiums. Part B standard premium is $185 per month in 2025. Under IRMA. By carefully managing your withdrawals and taxable income, you can often stay below these thresholds, saving thousands of dollars each year. For example, I've seen retirees who, by keeping their taxable income just $1,000 below the IRMA limit, saved $2,400 per year in Medicare premiums. Part B standard premium is $185 per month in 2025. That's real money that adds up over time. So, to recap, we've covered the 5 key steps to implementing a tax-efficient withdrawal strategy: inventorying your accounts, mapping your timeline, optimizing your withdrawal sequence, using Roth conversions strategically, and monitoring Social Security and Medicare thresholds. Each of these steps can be completed in a few weeks with the right help, and together they can make a dramatic difference in your retirement security. But before you take action, you need to avoid these critical mistakes that could cost you dearly. Part 4. Costly mistakes that drain your retirement. How to spot and avoid them. Now that you have a clear, actionable framework for tax-efficient withdrawals, it's absolutely vital to recognize the common mistakes that can sabotage even the best-laid plans. In my 30-plus years of guiding retirees, I've seen far too many people lose tens of thousands, sometimes hundreds of thousands, of dollars because of simple missteps that could have been avoided with a little extra care and the right information. If you want to keep more of your money working for you, rather than lining the pockets of the IRS or insurance companies, you must know what these pitfalls look like and how to steer clear of them. Let me remind you again, this is educational content, not personalized financial advice. Your individual situation is unique, and you should always consult a qualified financial advisor before making any decisions. But by learning from the mistakes of others, you can protect your nest egg, reduce your stress, and enjoy the retirement you've earned. Let's look at the most expensive and common mistakes I've seen retirees make, the warning signs to watch for, and the real financial cost that comes from getting these wrong. Mistake number 1. Ignoring required minimum distributions, RMDs, or miscalculating them. One of the most frequent and costly errors is failing to take your required minimum distributions from traditional IRAs or 401ks once you reach age 73. The IRS is very strict about RMDs. If you miss even a portion of your required withdrawal, the penalty is a whopping 25% of the amount you should have taken, in addition to the regular income tax. For example, if your RMD is $20,000 and you forget to withdraw it, you could owe $5,000 in penalties plus taxes, a painful and completely avoidable hit. I've seen clients who thought they could delay their first RMD or who didn't realize they needed to take one from each account. Others made the mistake of thinking their financial institution would handle it automatically. Warning signs include not receiving annual notices from your IRA custodian, not keeping a personal calendar of key dates, or assuming that someone else is tracking this for you. The financial cost of missing RMDs can easily run into the tens of thousands over a decade, especially if the error goes unnoticed for several years. Mistake number 2. Withdrawing too much too soon from tax-deferred accounts. Another expensive pitfall is taking large withdrawals from your traditional IRA or 401k early in retirement, especially before age 73, without considering the tax impact. Many retirees do this to pay off a mortgage, fund a major purchase, or simply because they think they need the money. The problem? Large withdrawals can push you into a higher tax bracket, trigger more of your Social Security benefits to become taxable, and even bump you into higher Medicare premium tiers, IRA. Let me give you an example. I worked with a couple who decided to withdraw $100,000 from their IRA in 1 year to buy a vacation home. That one decision pushed them from the 12% to the 22% federal tax bracket, caused 85% of their Social Security benefits to be taxed, and raised their Medicare premiums. Part B standard premium is $185 per month in 2025, by $2,400 each, totaling nearly $16,000 in extra taxes and costs that year alone. If you find yourself planning a large withdrawal, always run the numbers and look at the total impact, not just the immediate need. Warning signs include not coordinating withdrawals with your tax advisor, not reviewing your projected taxable income for the year, or thinking, I'll just pay the tax and be done with it. Mistake number 3. Overlooking Roth conversion timing and tax bracket management. Roth conversions can be a powerful tool, but if done without a careful plan, they can backfire. One of the biggest mistakes is converting too much in a single year, which can push you into a much higher tax bracket and cause unnecessary tax pain. For example, if you convert $200,000 at once, you might jump from the 12% to the 24% or even 32% bracket, doubling or tripling your tax bill. I've seen retirees who thought they were being proactive, but ended up with a tax bill $30,000 higher than necessary because they didn't spread conversions over several years. The warning signs here include not reviewing your tax brackets before making a conversion, not coordinating with your Social Security start date, or not considering how the conversion will affect your Medicare premiums. Part B standard premium is $185 per month in 2025. 2 years later, since IRA is based on your tax return from 2 years prior. The financial cost of poor Roth conversion timing can easily exceed $50,000 over retirement, especially if it triggers higher taxes and healthcare costs year after year. Mistake number 4. Failing to coordinate withdrawals with Social Security and Medicare. A subtle but very expensive mistake is not coordinating your withdrawal strategy with your Social Security claiming age and Medicare enrollment. If you start Social Security early and then take large IRA withdrawals, you may unintentionally push more of your benefits into the taxable column and raise your Medicare premiums. Part B standard premium is $185 per month in 2025. Conversely, delaying Social Security and using withdrawals to fill up lower tax brackets can create a much more favorable long-term outcome. For instance, a retiree who claimed Social Security at 62 and took $40,000 per year from their IRA saw their benefits taxed at the highest possible rate and paid $3,000 more per year in Medicare premiums. Part B standard premium is $185 per month in 2025, than if they had delayed and used a different withdrawal sequence. Over a 20-year retirement, that's $60,000 lost to avoidable taxes and surcharges. Warning signs include not reviewing your Social Security taxation before starting benefits, not projecting your Medicare premiums. Part B standard premium is $185 per month in 2025, based on your income, or making withdrawal decisions in isolation without looking at the big picture. If you're unsure how your withdrawals will affect these programs, it's time to consult a professional. Other pitfalls: falling for too good to be true schemes. Let me also mention one more pitfall that's become increasingly common: falling for high-pressure sales tactics or guaranteed investment schemes that promise huge returns or tax-free income for life. In my decades of experience, I've seen too many retirees lured into annuities or insurance products with hidden fees, surrender charges, or complex tax consequences. If anyone promises you a no-risk, high-return product, be skeptical. Warning signs include aggressive sales pitches, lack of clear written information, or pressure to act before the window closes. Remember, if it sounds too good to be true, it probably is. Let me repeat this crucial point. This is educational content, not personalized financial advice. The most successful retirees I work with are those who ask questions, double-check the math, and never rush into a financial decision without understanding all the implications. So far, we've covered 4 of the most expensive mistakes I've seen seniors make with their retirement withdrawals: missing RMDs, withdrawing too much too soon, mistiming Roth conversions, and failing to coordinate with Social Security and Medicare. Each of these can cost you tens of thousands of dollars or more, but the good news is that with awareness and careful planning, you can avoid them. Once you avoid these traps, you can access advanced strategies that most people never learn. Part 5. Advanced Strategies and Optimization: Maximizing the Benefits of Tax-Efficient Withdrawals. Now that you've learned how to sidestep the most expensive retirement withdrawal mistakes, let's turn our attention to the advanced strategies that can truly set you apart from the average retiree. In my 30-plus years of helping seniors safeguard and grow their wealth, I've seen that the most successful retirees are those who go beyond the basics. They use sophisticated yet practical techniques to optimize every dollar, often unlocking tens or even hundreds of thousands in additional value over the course of their retirement. Let me remind you, this is educational content, not personalized financial advice. Every situation is unique, and you should always consult with a qualified financial advisor before implementing any advanced strategies. Tax laws can change, and what works for one retiree may not be the best fit for another. But understanding these options will put you in the driver's seat as you plan your financial future. Let's explore 3 of the most powerful advanced strategies for maximizing the benefits of tax-efficient withdrawals. Strategy number 1: Multi-Year Roth Conversion Ladder. We touched on Roth conversions earlier, but let's dig deeper into a technique that industry insiders know as the Roth Conversion Ladder. This involves systematically converting portions of your traditional IRA or 401k to a Roth IRA over a period of several years. ideally during the years after you retire, but before required minimum distributions. RMDs begin at age 73. Here's how it works. Instead of making a single large conversion that could push you into a higher tax bracket, you ladder your conversions. Each year, you convert just enough to fill up your current tax bracket, often the 12% or 22% bracket for many retirees. For example, a married couple filing jointly in 2024 can have up to $94,300 in taxable income and remain in the 12% bracket. If your other income totals $54,300, you could convert up to $40,000 from your IRA to a Roth that year and stay within that favorable bracket. The power of this approach lies in spreading the tax bill over several years at lower rates, reducing your future RMDs, and building up a pool of tax-free income for later in retirement. Over a 5 to 10 year period, a well-planned Roth conversion ladder can save you $50,000 or more in taxes and help shield you from future tax rate increases. It also gives you more flexibility in managing your income in later years, which is especially valuable if you face large unexpected expenses or want to leave a tax-free inheritance to your heirs. But be cautious. Roth conversions increase your taxable income in the year you convert, which can affect Medicare premiums. Part B standard premium is $185 per month in 2025. IRMA and the taxation of Social Security benefits. That's why timing and careful coordination are critical. The most successful retirees I work with review their conversion opportunities every year and adjust the amount based on their income, expenses, and tax law changes. Strategy number 2, tax harvesting and asset location optimization. Another sophisticated approach is tax loss harvesting combined with asset location optimization. Let's break that down in simple terms. Tax loss harvesting is the practice of selling investments in your taxable brokerage account that have declined in value, realizing the loss for tax purposes. You can use these losses to offset capital gains elsewhere in your portfolio, and up to $3,000 per year can even be applied against ordinary income. For example, if you have $20,000 in realized losses and $15,000 in gains, you'll owe no tax on your gains, and you can deduct $3,000 from your income, carrying the rest forward to future years. This can save you thousands in taxes, especially in volatile markets. Asset location, meanwhile, is about placing the right types of investments in the right accounts for maximum tax efficiency. For instance, bonds and high-dividend stocks, which generate regular taxable income, are often best held in tax-deferred accounts like IRAs or 401ks. Growth stocks, which you plan to hold for many years, may be better suited for taxable accounts where you can benefit from lower long-term capital gains rates. Tax-free municipal bonds can be held in taxable accounts to avoid federal taxes altogether. By combining tax loss harvesting and asset location, you can lower your annual tax bill and allow more of your money to compound over time. In my experience, retirees who use these techniques can boost their after-tax returns by 1% to 2% per year, a difference that adds up to $50,000 to $100,000 or more over a typical retirement. The key is to review your portfolio annually and make adjustments as needed, especially after market downturns or big life changes. Strategy number 3. Qualified Charitable Distributions, QCDs, for tax-free giving. For those who are charitably inclined, the Qualified Charitable Distribution, QCD, is a powerful tool that allows you to support your favorite causes while reducing your tax burden. Once you reach age 70 and a half, you can direct up to $100,000 per year from your IRA directly to qualified charities. These distributions count toward your RMDs but are not included in your taxable income, effectively making them tax-free. Let's look at an example. Suppose you have a $20,000 RMD this year and you want to donate $10,000 to your church or a local nonprofit. By using a QCD, that $10,000 never appears on your tax return, lowering your adjusted gross income. This can help you stay below key thresholds for Medicare IRMA and Social Security taxation, potentially saving you thousands in taxes and healthcare costs. Over a decade, regular QCDs can save you $20,000 or more in taxes, all while supporting causes that matter to you. The warning here is to make sure the distribution goes directly from your IRA to the charity. If you withdraw the money first and then write a check, you lose the tax benefit. And always keep clear records for the IRS. Many retirees overlook this strategy, but it's one of the best-kept secrets for tax-efficient giving. Tax implications and long-term benefits. All of these advanced strategies, Roth conversion ladders, tax loss harvesting, and asset location, and QCDs, require careful planning and coordination. Each has its own set of tax implications, and the benefits multiply when you use them together as part of a comprehensive plan. The most successful retirees I work with review their withdrawal strategy, investment allocation, and charitable giving every year, making adjustments as tax laws and personal circumstances change. Let me repeat, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor and a tax professional before implementing these advanced strategies. The rules can be complex, and a misstep can be costly. But with the right guidance and a proactive approach, you can unlock powerful benefits. More income for you, more for your family, and more for the causes you care about. So far, we've explored the most effective advanced strategies for maximizing your retirement savings and minimizing taxes. You've learned how a multi-year Roth conversion ladder can save you a fortune, how tax loss harvesting and asset location can boost your after-tax returns, and how qualified charitable distributions can allow you to give generously while reducing your tax bill. The key to success is getting your timing exactly right. Each of these strategies works best when implemented in the right sequence and at the right time. But how do you put all these pieces together into a clear step-by-step plan? That's what we'll cover next. Timing is crucial. Here's exactly when to take each step for maximum impact. Part 6. Implementation Timeline and Sequence. Your 90-day roadmap to tax-efficient withdrawals. You've now gathered a powerful toolkit of strategies, everything from tax-efficient withdrawal sequencing and Roth conversion ladders to tax loss harvesting and qualified charitable distributions. But as I've seen time and again in my 30-plus years of guiding retirees, knowledge alone is not enough. The most successful retirees are those who take consistent, timely action. Timing, sequencing, and deadlines can make the difference between saving a fortune and missing out on life-changing opportunities. Let me remind you, this is educational content, not personalized financial advice. Your situation is unique, and you should always consult a qualified financial advisor before making decisions. But with that in mind, let's walk through a clear step-by-step 90-day implementation plan, one that's designed for safety, clarity, and maximum impact for retirees like you. First 30 days, laying the groundwork. In the first month, your focus should be on organizing, inventorying, and clarifying your current position. This is the foundation that everything else will rest upon. Start by gathering all your financial account statements, traditional IRAs, 401ks, Roth IRAs, brokerage accounts, and any annuities or pensions. Don't forget to include your Social Security statement, which you can access online at ssa.gov. If you're married, do this for both you and your spouse. It's not uncommon for retirees to discover old accounts they'd forgotten about. Every dollar matters when you're building your strategy. Once you've gathered your documents, create a summary sheet. List each account, the current balance, the type, taxable, tax-deferred, or tax-free, and the expected annual income or withdrawal you'll need from each. Note your current age, your spouse's age, and your planned retirement date if you haven't retired yet. During this first 30 days, schedule a meeting with a qualified financial advisor and, if possible, a tax professional. Share your summary sheet with them and discuss your goals. Do you want to minimize taxes, maximize income, leave a legacy, or all of the above? The sooner you bring in professional guidance, the more tailored and effective your plan will be. Keep in mind, many advisors have waiting lists. Scheduling this meeting early is essential. Finally, set up a secure digital or physical folder for your retirement documents. This will save you countless hours down the road and make annual reviews much easier. Days 31 to 60. Designing and testing your withdrawal plan. With your foundation in place, the next 30 days are about designing your withdrawal sequence and testing different scenarios. This is where you start to see how all the pieces can work together for maximum tax efficiency. Work with your advisor to map out a year-by-year withdrawal timeline. For example, if you're 65 now, plan what your withdrawals will look like at ages 66, 67, and so on, especially focusing on the years before required minimum distributions, RMDs, begin at age 73. If you're considering Roth conversions, identify the gap years between retirement and RMDs when your taxable income is likely to be lowest. Run projections for different Social Security claiming ages. For many retirees, delaying Social Security until age 70 can increase your benefit by up to 32% compared to claiming at 62. But you'll need to fill the income gap with withdrawals from your savings. This is where sequence matters most. Model how your taxable income, Medicare premiums, Part B standard premium is $185 per month in 2025, and Social Security taxation will change under different withdrawal scenarios. If you have taxable brokerage accounts, review your unrealized gains and losses with your advisor. Identify opportunities for tax loss harvesting and decide which assets are best held in which accounts for optimal tax treatment. This is also the time to consider whether qualified charitable distributions, QCDs, make sense for you, especially if you're age 70 and a half or older. During this period, create a calendar of important deadlines. Note the following. April 1st of the year after you turn 73, your first RMD deadline. December 31st each year, last day to complete Roth conversions, QCDs, and most tax loss harvesting actions. October 15th. Medicare open enrollment if you need to review your plan based on changes in income. Social Security application window. You can apply up to 4 months before you want benefits to begin. By the end of this 30-day window, you should have a draft withdrawal plan for the next 5 to 10 years, a list of key deadlines, and a clear sense of which actions need to be taken in the next 12 months. Days 61 to 90, taking action and setting up annual reviews. The final phase of your 90-day plan is about execution and building in ongoing accountability. This is where you move from planning to action and where many retirees see the greatest results. First, implement your withdrawal plan for the current year. If you're doing a Roth conversion, work with your advisor and tax professional to ensure the paperwork is completed before December 31st. If you're taking RMDs, set up automatic withdrawals with your IRA or 401k custodian. This helps avoid costly penalties for missed distributions. If you're utilizing tax loss harvesting, instruct your advisor or brokerage firm to sell the appropriate investments and reinvest the proceeds according to your asset allocation plan. For QCDs, contact your IRA custodian to make direct transfers to your chosen charities and keep detailed records for tax reporting. Next, set up reminders for key deadlines, both for this year and for future years. Many retirees find it helpful to use a digital calendar or a simple paper planner. Mark dates for annual reviews, RMDs, Roth conversion windows, and Medicare open enrollment. This ensures nothing slips through the cracks as tax laws and your personal situation evolve. Finally, schedule an annual review with your advisor and tax professional. The most successful retirees I've worked with treat this like a health checkup for their finances, reviewing their withdrawal sequence, tax situation, and investment allocation every year. Adjust your plan as needed to account for changes in tax laws, market conditions, or your personal goals. Important deadlines and dates. Recap. Let me pause and recap the most critical deadlines. April 1st after the year you turned 73. First RMD due. December 31st each year. Deadline for RMDs, Roth conversions, QCDs, and most tax planning moves. October 15th. Medicare open enrollment ends. Up to 4 months before your desired Social Security start date. Earliest you can apply for benefits. Missing any of these deadlines can cost you thousands in penalties, missed benefits, or higher taxes. For example, failing to take your RMD by December 31st can trigger a penalty of up to 25% of the amount you should have withdrawn, reduced from 50% under Secure 2.0 or 10% if corrected within 2 years. That's a risk you never want to take. Putting it all together, so far, we've mapped out a 90-day implementation plan, 30 days to organize and gather your information, 30 days to design and test your withdrawal sequence, and 30 days to execute your plan and set up annual reviews. Each step builds on the last, creating a safety-first, tax-efficient strategy that puts you in control of your retirement. Let me repeat, this is educational content, not personalized financial advice. Consult with a qualified advisor to tailor this timeline to your specific situation. The sooner you start, the more options you'll have and the more you can save. But even with the best laid plans, you might encounter roadblocks along the way. The tax code is complicated, markets can be unpredictable, and life has a way of throwing curveballs. That's why it's so important to know how to troubleshoot common challenges and stay on course. Even if you follow this perfectly, you might encounter these common roadblocks, and knowing how to overcome them can make all the difference. Part 7. Troubleshooting and Problem Solving. Overcoming roadblocks on your path to tax-efficient retirement. You've now built a robust plan for tax-efficient withdrawals, mapped out a precise timeline, and set up annual reviews to keep yourself on track. But as anyone who's been through retirement planning knows, even the best-laid strategies can run into unexpected hurdles. Over my 30-plus years of helping retirees, I've seen that the difference between those who achieve lasting financial security and those who struggle often comes down to how they handle these inevitable roadblocks. Let me remind you again, this is educational content, not personalized financial advice. Your situation is unique, and you should always consult with a qualified financial advisor and tax professional before making any decisions. But let's talk through some of the most common challenges you might face, and more importantly, how to address them with confidence and clarity. Challenge number 1. Market volatility disrupts your withdrawal plan. Picture this. You've set up your withdrawal sequence, but then the market takes a sudden downturn. Your taxable brokerage account drops 15%, and you're nervous about selling investments at a loss just to meet your income needs. This is a scenario I've seen many times, and it's a valid concern. Here's the solution. Build flexibility into your withdrawal plan. The most successful retirees I work with maintain at least 1 to 2 years' worth of living expenses in cash or ultra-short-term bond funds. This safety bucket allows you to draw income without selling stocks during a downturn, giving your portfolio time to recover. If you haven't set this up yet, consider gradually moving a portion of your portfolio into liquid, low-risk holdings over the next 6 to 12 months. What if you're already in a downturn and need cash now? Consider tapping your Roth IRA if you're over 59 and a half and have met the 5-year rule for tax-free withdrawals. Alternatively, look for opportunities to harvest tax losses in your taxable account, selling losing positions to offset gains and lower your tax bill. And always revisit your withdrawal plan annually to adjust for market changes. Challenge number 2. Unexpected healthcare costs or family emergencies. Life is full of surprises. A sudden health crisis, A need to help a family member or a major home repair can throw your withdrawal plan off balance. I've seen retirees forced to make large, unplanned withdrawals, which can push them into a higher tax bracket, trigger Medicare IRMA surcharges, and even increase the portion of Social Security that's taxed. Here's how to handle it. First, if you know you'll need a large sum, work with your advisor to spread withdrawals over 2 tax years if possible. This can keep you from jumping into a higher bracket. For example, if you need $40,000 for a medical procedure in December, see if you can take $20,000 in December and $20,000 in January. This simple timing move can save you thousands in taxes. What if you're facing repeated or ongoing expenses, such as long-term care? Review your insurance policies and consider whether a hybrid long-term care policy or annuity could help cover future needs. And don't forget, medical expenses above 7.5% of your adjusted gross income are deductible if you itemize, so keep detailed records and consult your tax professional each year. Challenge number 3. Changes in tax laws or required minimum distribution, RMD rules. Congress changes the tax code more often than most people realize. Over the years, I've seen RMD ages increase, capital gains rates shift, and new rules for inherited IRAs introduced. Many retirees worry that a sudden change could undermine their carefully crafted plan. The solution is to stay informed and stay flexible. Schedule an annual review with your advisor each fall, after Congress has typically finalized tax changes for the coming year. Make sure your withdrawal strategy is up to date with the latest rules. For example, if the RMD age moves from 73 to 75, you may have an extra window for Roth conversions or tax loss harvesting. What if you're caught off guard by a new rule? Don't panic. Most changes include a transition period. Take the time to understand the new rules and work with your advisor to adjust your plan. For inherited IRAs, the SECURE Act's 10-year rule means beneficiaries must empty the account within 10 years. So if you plan to leave an IRA to your heirs, consider whether Roth conversions now could help them avoid a future tax crunch. Challenge number 4. Overlook deadlines and administrative errors. Even the most diligent retirees can miss a deadline or make a paperwork mistake. Maybe you forget to take your RMD by December 31st, or your IRA custodian makes an error processing your Qualified Charitable Distribution QCD. The IRS penalties can be steep, up to 25% for missed RMDs, and you could lose valuable tax benefits if a QCD isn't done correctly. Here's how to avoid these costly errors. Automate as much as possible. Set up automatic RMD withdrawals with your financial institution. Use digital calendars or reminders for key deadlines, especially December 31st, for RMDs, Roth conversions, and QCDs. When making a QCD, always double-check with your custodian that the funds go directly from your IRA to the charity, never to you first. If you do make a mistake, don't ignore it. The IRS has procedures for requesting a waiver of the RMD penalty if you correct the mistake promptly and have a reasonable explanation. Work with your advisor or tax preparer to file the necessary forms. The most successful retirees I've worked with are proactive about fixing mistakes and learning from them rather than letting fear or embarrassment get in the way. What if scenarios and solutions? What if the market crashes just as you're about to retire? Revisit your withdrawal rates, reduce discretionary spending for a year or two, and lean on your safety bucket of cash. What if you inherit a large IRA or your spouse passes away? Review the new beneficiary rules, update your withdrawal plan, and consult both a tax advisor and a state attorney to minimize taxes and protect your legacy. What if your health changes and you need to move into assisted living or skilled care? Review your long-term care options, consider Medicaid planning if necessary, and look for ways to use tax-free distributions from HSAs or hybrid annuities to cover costs. And always keep your trusted advisors in the loop, especially if your family situation changes. Let me emphasize, the most successful retirees I've guided are not those who never face challenges, but those who prepare for the unexpected, ask questions, and update their plans as life unfolds. There's no shame in hitting a roadblock. What matters is how you respond and adapt. So far, we've covered how to troubleshoot the most common and most stressful challenges that can derail a tax-efficient withdrawal strategy. You've learned practical solutions for market volatility, healthcare surprises, tax law changes, and administrative errors. And you've seen that with the right mindset and support, you can overcome almost any obstacle on your retirement journey. Once you master this foundation, you're ready for the next level, where you can truly optimize, scale, and future-proof your retirement plan for decades to come. That's just the beginning. Here's where it gets really powerful. Part 8. Next Level Actions and Optimization. Scaling, maximizing, and future-proofing your retirement plan. You've come a long way. You now understand the core principles of tax-efficient withdrawals, have a step-by-step roadmap, and know how to troubleshoot the most common challenges. But in my 30-plus years of helping affluent retirees, I've seen that those who truly thrive in retirement don't just stop at the basics. They take their planning to the next level. They look for ways to maximize every dollar, adapt to changing circumstances, and ensure their wealth continues to work for them and their families for decades to come. Let me remind you, as always, this is educational content, not personalized financial advice. The strategies I'm about to share are advanced and should be reviewed with a qualified financial advisor and tax professional before you take action. But if you want to scale your results, optimize for the long term, and build a legacy, these next-level techniques are essential. Advanced technique number 1, dynamic withdrawal strategies. Most retirees start with a set-it-and-forget-it withdrawal rate, say 4% per year. But the most successful retirees I work with use dynamic withdrawal strategies that adjust based on market performance, inflation, and spending needs. For example, if markets are strong and your portfolio grows by 8% in a year, you might increase your withdrawals by 2 to 3% to enjoy a little more, or fund a special trip. If there's a downturn and your investments drop by 10%, you might temporarily reduce withdrawals by 5 to 10% to preserve your principal. Over a 20-year retirement, this flexible approach can add $50,000 to $150,000 in extra spending power while reducing the risk of running out of money. You can also use guardrails, preset limits for adjusting your withdrawals. For instance, if your portfolio is above a certain value, increase withdrawals. If it falls below, tighten your belt. This approach has a 40-plus year track record of helping retirees weather market storms without sacrificing their lifestyle. Advanced technique number 2, strategic gifting and legacy planning. If leaving a legacy is important to you, there are powerful tax-savvy ways to pass wealth to your children, grandchildren, or favorite charities while minimizing taxes. One popular method is annual gifting. In 2024, you can give up to $17,000 per year per person without triggering gift taxes. Over a decade, a couple could transfer $340,000 to 4 grandchildren, completely tax-free. For larger estates, consider setting up a trust, such as a charitable remainder trust or a family irrevocable trust, to control how assets are distributed, reduce estate taxes, and protect your heirs from creditors or divorce. Trusts can be complex, but for retirees with $1 million or more in assets, they can save hundreds of thousands in taxes and ensure your wishes are honored. Don't overlook the power of Roth IRAs as an inheritance. Unlike traditional IRAs, Roths pass to your heirs income tax-free, and while the new 10-year rule requires beneficiaries to empty the account within a decade, the growth during that period is still tax-free. Converting to Roth now can be a tremendous gift to your family down the road. Advanced technique number 3, tax diversification and income layering. Most people think of diversification in terms of investments, but tax diversification, having assets in taxable, tax-deferred, and tax-free accounts gives you maximum flexibility. The most successful retirees use income layering to pull from different buckets depending on their needs and the tax environment. For example, in a high-tax year, perhaps you sell a property or receive a large inheritance. You might draw more from your Roth IRA to avoid pushing yourself into a higher bracket. In a low-tax year, you might take extra from your traditional IRA or do a larger Roth conversion. By strategically mixing sources, you can keep your taxable income in the most favorable range, avoid Medicare IRMA surcharges, and minimize taxes on Social Security. This approach also allows you to respond to future tax law changes. If Congress raises income taxes or changes RMD rules, you'll have options. If tax rates fall, you can accelerate withdrawals from tax-deferred accounts. It's all about giving yourself more levers to pull so you're never boxed in by a single strategy. Advanced technique number 4, ongoing tax harvesting and rebalancing. The most successful retirees don't just harvest tax losses during downturns, they do it every year, locking in losses to offset gains and reduce taxes. At the same time, they rebalance their portfolios annually to maintain their desired risk level. This set and review approach can add 1 to 2% per year in after-tax returns over the long run. For instance, if you have $25,000 in unrealized losses and $20,000 in gains, you can sell both, pay no tax, and reinvest according to your plan. Over 20 years, this could mean an extra $50,000 to $100,000 in your pocket. Money that compounds for you, not the IRS. Long-term considerations, planning for longevity, inflation, and changing needs. As you move deeper into retirement, new considerations come into play. Healthcare costs typically rise in your 70s and 80s. Many retirees spend $250,000 or more on out-of-pocket health care over their lifetime. Make sure your withdrawal plan accounts for rising medical expenses and consider supplemental insurance or a health savings account, HSA, if you have one. Inflation is another long-term risk. Over a 20-year retirement, even 3% inflation will cut your purchasing power in half. The most successful retirees I've worked with keep a portion of their portfolio in growth assets, like stocks or inflation-protected bonds, to ensure their income keeps pace. And don't forget to update your plan as life changes. The birth of a grandchild, the loss of a spouse, a move to a new state with different tax laws, all of these should prompt a review of your withdrawal strategy, estate plan, and insurance coverage. The retirees who thrive are those who make adjustments every year, not just once a decade, scaling and optimizing for the next generation. If you want to truly scale your impact and create a lasting legacy, consider involving your children or heirs in your planning. Share your strategy, educate them about the importance of tax efficiency, and introduce them to your advisors. This not only reduces confusion and conflict later, but it also empowers your family to continue making wise financial decisions long after you're gone. You might even consider giving while living, helping your loved ones with education, home purchases, or business ventures while you're alive to see the results. Many retirees find this deeply rewarding, and with the right strategy, you can do it in a way that's tax-smart and sustainable. Bringing it all together. So far, we've covered how to take your retirement planning from good to great, using dynamic withdrawals, strategic gifting, tax diversification, ongoing tax harvesting, and regular reviews to maximize your results and future-proof your plan. These are the exact strategies I've seen the most successful, confident retirees use to live well, give generously, and leave a legacy that lasts. Let me repeat. This is educational content, not personalized financial advice. Consult with a qualified advisor to tailor these advanced strategies to your unique situation. The sooner you begin, the more options you'll have, and the more you can enjoy the retirement you've earned. Now, as you look to put these next-level strategies into action, remember that the financial landscape is always evolving. Staying engaged, informed, and proactive is the real secret to long-term success. In our next session, I'll show you how to stay ahead of the curve so you can adapt, thrive, and protect your wealth no matter what the future brings. Over the past hour, we've covered a tremendous amount of ground together. We started by exposing the hidden tax traps that drain retirement savings, and we validated just how much is at stake, often tens or even hundreds of thousands of dollars for American seniors with substantial nest eggs. We then introduced the core solution, tax-efficient withdrawal sequencing, and why it's so powerful for retirees like you. We walked step by step through practical implementation, spotlighted the most expensive mistakes to avoid, and revealed advanced optimization techniques that the most successful retirees use. We mapped out a 90-day timeline, tackled real-world troubleshooting scenarios, and finally explored next-level strategies for maximizing results and building a lasting legacy. This isn't just entertainment, it's valuable financial education. The knowledge you've gained today could save you and your family a fortune in unnecessary taxes, penalties, and missed opportunities. In my decades of helping retirees optimize their finances, I've seen these strategies work for thousands of families across different market conditions. What separates financially secure retirees from those who struggle is usually knowledge and implementation. You've just received decades of experience distilled into practical, actionable guidance. Now that you understand each piece, here's how they work together to form a comprehensive, integrated strategy. By coordinating the timing, sequence, and source of your withdrawals across taxable, tax-deferred, and tax-free accounts, you can dramatically minimize your tax burden, keep your Medicare premiums. Part B standard premium is $185 per month in 2025, in check, and maximize your after-tax income. When you add in smart Roth conversion ladders, ongoing tax loss harvesting, and qualified charitable distributions, the compound effect is enormous. Let me emphasize this important point. A retiree following this complete approach typically saves $50,000 to $200,000 or more over a 25-year retirement compared to someone who simply wings it. That extra savings can mean more travel, better health care, greater security, or a larger legacy for your children and grandchildren. This is why the wealthy retirees I advise consistently outperform those with even larger starting balances. They follow proven systems, review their plans annually, and adapt as laws and markets change. The aha moment here is that you don't need to take outsized investment risks or chase the latest fads. Instead, you simply need to optimize what you already have with a coordinated, tax-smart approach. So what can you do right now to start putting this into action? Here are your next steps for the next 30 days. Step 1. Assessment phase, first week. Start by gathering your 3 essential documents: your most recent account statements for all IRAs, 401ks, Roth IRAs, and taxable brokerage accounts, your latest Social Security statement, and your last 2 years' tax returns. Calculate your current position using a simple worksheet. List your accounts, balances, and expected withdrawal needs for the next year. Identify your biggest opportunity area, whether it's reducing RMD exposure, lowering Medicare premiums. Part B standard premium is $185 per month in 2025, or maximizing Roth conversions. Step 2. Planning phase, second week. Create your personalized withdrawal timeline based on your current age and retirement goals. Research the specific options we discussed, such as Roth conversion ladders, tax loss harvesting, and QCDs, and see which apply to your situation. Document your current withdrawal strategy and compare it to what you've learned today. Where are the gaps? What changes could make the biggest impact? Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor and, if possible, a tax professional. Bring these specific questions. How can I minimize my lifetime tax bill using withdrawal sequencing? What's my optimal Roth conversion amount this year? How will my withdrawals impact my Social Security and Medicare costs? Verify that your advisor understands these advanced strategies and can model different scenarios for you. The most successful clients I've worked with consistently apply these principles with professional support. Step 4. Implementation begins, 4th week. Start with the lowest risk, highest impact change first, such as setting up automatic RMD withdrawals or executing a modest Roth conversion within your current tax bracket. Set up the systems and accounts needed for your new strategy, including separate buckets for taxable, tax-deferred, and tax-free income. Begin tracking your progress using simple metrics: annual tax paid, net withdrawal amount, and changes in Medicare premiums. Part B standard premium is $185 per month in 2025. You'll know you're on the right track when your financial stress decreases and you have clear answers to questions that used to keep you awake at night. Remember, every financial strategy carries some level of risk. The goal isn't perfection, it's optimization based on your unique situation and goals. Most successful retirees implement these changes gradually over 6 to 12 months, not all at once. Don't let perfectionism prevent you from starting with small improvements. These aren't get-rich-quick schemes. They're proven long-term strategies designed to protect your wealth and provide peace of mind, even as markets and laws shift. What matters most is taking the first step and building momentum. You're now part of a community of informed retirees who refuse to settle for average results. The journey to financial optimization is ongoing. Markets change, tax laws evolve, and new opportunities emerge. Continue your education by staying informed about retirement planning developments, and don't hesitate to revisit your plan each year. Share your success stories and learn from others who are implementing these strategies. Your experience and wisdom combined with these proven techniques create a powerful advantage, not just for you, but for your family and future generations. If this video helped clarify your retirement planning strategy, please give it a thumbs up so others can benefit as well. Share your biggest takeaway in the comments. What surprised you most, or which strategy will you implement first? Subscribe for more in-depth retirement guidance that could save you thousands over the years. And most importantly, take action on what you've learned. Your future self and your loved ones will thank you. Let me close with a few vital reminders. This has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial and tax professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and the tax implications we discussed may change based on future legislation. While this information provides a strong foundation, professional guidance is invaluable. A qualified financial advisor can help you customize these strategies for your specific situation. Tax professionals can ensure you're maximizing benefits while staying compliant, and estate planning attorneys can help with the legal aspects we discussed. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight, knowing you have a clear plan for your financial future. Your children and grandchildren will benefit from the wise decisions you make today. Maintain your independence by taking control of your financial destiny. You've worked too hard to accept anything less than optimal planning. The sooner you implement these strategies, the more time they have to work in your favor. Every month you delay is a month of potential optimization lost. The cost of inaction often exceeds the cost of making imperfect but informed decisions. You now have knowledge that many retirees never acquire. Use it to your advantage. What surprised you most about the strategies we covered today? Which of these approaches best fits your retirement situation? Have you already implemented any of these strategies? Share your experience below. What's your biggest concern about retirement planning that we should address next? If you could ask a financial advisor one question based on this video, what would it be? Success looks like having clear answers to the questions that used to keep you awake at night. The goal is progress, not perfection. Small improvements compound over time. Measure your success by increased confidence in your financial decisions and the peace of mind you feel about your future. Thank you for investing your time and trust in this journey. You have the tools, the knowledge, and the support to make the most of your retirement. Now take the next step. Your financial future is in your hands. Tax laws and HSA contribution limits are subject to change by Congress and the IRS. This content reflects 2025 limits and may not reflect future changes.